Welcome back to the Global Ledger. I'm Justin. For the last several episodes, we've traced the anatomy of crisis, how liquidity appears, how it disappears, why bank runs are now digital, and how shadow banking creates both incredible efficiency and incredible fragility. Today, we take all of that work and look forward, not to predict the future, but to map where the pressure points are. Modern market microstructure in the institutional architecture described by the Federal Reserve itself. This episode isn't about fear or meant to scare anybody or anything like that. We just want to get some clarity because the future is only frightening when you can't see the plumbing. Let's get into it. Crises don't come from where people expect. If you ask most people what could cause the next financial crisis, they'll say government debt, inflation, politics, tax policy, banks behaving badly, be another one. But crises never begin where the public narrative lives. Crises start in the points, I would say, Perry Mehrling emphasizes repeatedly. Mismatches, promises, balance sheets, liquidity structures, and payment obligations. Crises begin when multiple actors try to climb the hierarchy of money at the same time, and the system can't deliver the high-level promises fast enough. So the question is not what news event triggers a crisis. The question is, where is it strained? So let's look at, I think, in my opinion, stress point number one. I would say the Treasury market. And yeah, the safest asset in the world, the U.S. Treasury, now faces structural liquidity issues. Why? Because primary dealers must absorb massive issuance. Balance sheet capacity is limited, and hedge funds are heavily leveraged through repo. Foreign buyers are more selective. And Treasury market microstructure is fragmented. And the Fed talks about this in their document, the Fed explained. It talks about how treasuries backstop the entire financial system, not just government spending. They're collateral, money-like assets, and settlement instruments for institutions. If the Treasury market's ability to trade smoothly is anything impaired, everything below it in the hierarchy really starts to shake. So this isn't a prediction of collapse, I'll mention, but just a recognition that the backbone of global finance has less slack than it used to. Stress point number two, I would argue, are money market funds versus banks. Money market funds, like we've talked about before, are now so large, very frictionless, and so tightly connected to the Fed's overnight RRP facility that they compete directly with banks for deposits. This creates a structural pressure, in my opinion. As an example, when rates rise, deposits leave banks and flow into MMFs. MMFs place cash at the Fed's RRP facility. Banks lose funding and must sell assets. Asset sales depress prices. You see where I'm kind of going here? Depressed prices increase mark-to-market losses, and losses accelerate outflows. This is sort of like the SVB mechanism, but scaled to institutions. It's a slow burning fuse, you could say, but a fuse nonetheless. So brings me to stress point number three, the private credit boom. Private credit funds are now performing bank-like functions, lending, warehousing risk, structuring credit, performing liquidity transformation. But they don't have deposit insurance, have access to the Fed, They don't operate under bank capital requirements, and they don't sit inside the payment system. They lend long and borrow short, using investor commitments really as their funding. What happens if investors want liquidity during a drawdown? You get the equivalent of a private credit run almost. So this sector is big and I'd say lightly regulated. Exactly the kind of place where a modern crisis can germinate in a way. So, which I'll mention number 4, stress point number 4. So, so far, we've talked about 3 stress points. So stress point number 1 was the Treasury market. Talked about number 2, which was money market funds versus banks. Number 3, private credit boom. And number 4, I would have to say derivatives and margin liquidity. Derivatives are huge, far larger than cash markets, and rely on variation margin, initial margin, and centrally cleared collateral. In periods of volatility, margin calls really can explode. This is what nearly broke the UK pension system in 2022. Really good thing to analyze when talking about stress points. They weren't insolvent per se; they were liquidating assets to meet margin. A global spike in margin demands, especially across rates markets, could force selling off treasuries, swaps, futures, MBS, credit instruments. This becomes a collateral spiral, like we've talked about in previous episodes. The more you sell, the more volatility rises. The more volatility rises, the more margin you owe. And the more margin you owe, the more you sell. And this is really a crisis, in a way, a system choking on its own promises. Number 5, stablecoins and tokenized liquidity. I will be talking about more of the stablecoin, the cryptocurrency, Bitcoin, tokenization, all these terms in later episodes. But for now, stablecoins are now embedded in global liquidity channels, settlement rails, offshore trading, FX arbitrage, inter-exchange collateral. And you might ask the question, they're backing assets? Mostly treasury bills, repo, commercial paper historically. But stablecoins behave like money market funds, but without the same regulatory framework. If confidence in a major stablecoin falters, redemptions spike, T-bills are liquidated, rates whipsaw, arbitrage flows explode, and on-chain liquidity collapses, so on and so forth. So this isn't a crypto crisis, it's a modern collateral crisis rooted through a new plumbing layer. So number 6, the global dollar shortage, really always a candidate, of course. So the world runs on dollars. Demand for dollars is structural. Supply of dollars really is cyclical. When global funding tightens, emerging markets, sovereigns suffer. Corporates scramble for hedges as well. Cross-currency basis swaps widen, right? Offshore dollar banks experience some stress. And dealers reduce risk warehousing. So everyone climbs upwards, and Perry Marilling mentions this all the time about climbing upward during times of crises, stress. So local currency to dollars to reserves to treasuries to Fed backstop. A global dollar shortage isn't really a prediction. It's just kind of just a reoccurring phenom. I mean, we've seen it time and time again. So what actually might break next? Here's the truth about this. Nothing breaks in isolation. Systems break along the lines of their mismatches. So the most realistic candidates for future crises, in my opinion, are a Treasury market liquidity shock, a run from banks into MMFs, plus overnight repo. So it's 2. Number 3, a private credit liquidity mismatch. Number 4, derivatives margin shock. Number 5, a stablecoin redemption spiral. 6, a global dollar funding squeeze. In 7, a repo market collateral spiral. So, and not because any of these are weak, but because they are tightly coupled, high speed, and interdependent. So, crises occur when payment obligations cannot be met in time. The future of crisis really is about speed, not size. So, what about the Fed's future role in their part as dealer of last resort? I've said this over and over again, but the Fed talks about in their document. The Fed explained. They make it clear that their mission includes financial stability, liquidity support, and interruption of systemic contagion, but always after stress emerges, not before. Future crises will require faster liquidity provisions, facility activation without, the stigma, right? Broader collateral acceptance, deeper Treasury market backstops, definitely coordination with foreign central banks. That's a big one. And real-time funding tools, I think, for non-banks through intermediaries. So the Fed is evolving from a lender of last resort to kind of a dealer of last resort, in my opinion. So because modern crises live not in banks, but in markets. Thank you for listening to episode 40 of the Global Ledger. We talked about crises aren't random. They come from structure. They come from mismatches in liquidity, collateral, funding models, and expectations. The future, I don't think, is going to be defined by bigger crises, but really by faster ones, fueled by the digital money, algorithmic liquidity, and the accelerating rhythm of global finance. But when you understand this, the plumbing, the infrastructure, you understand the risk. And when you understand the risk, you're no longer afraid of the future. In episode 41, we're going to shift gears and to a new arc, where this is the last episode of Arc 3. In Arc 4, we're going to really start getting into more financy, I should say. In episode 41, it's going to be, we're going to go where money meets valuation. And we're going to start with the cost of capital. So all the individuals really interested in the finance side, I'm going to do my best to try to connect everything we've learned so far up with finance and valuation, and try to get into the nitty-gritty of this. So once again, I'm Justin, and thanks for being here.